we talked about the three methods of depreciation, right? If you remember, we did this one, and we did the ones after that. I just wanted to basically remind you of this one. So that we would start from here, okay? Think of it as a warm-up or something like that. So we talked about the three methods of depreciation, which were straight line method, units of activity method, and the declining balance method. And when we talked about the double declining balance method, the depreciation rate will be twice that of the straight line method. I know you guys had the answer, but you probably know the answer already to this one. However, we just want to refresh our memory with this. As you know, I have extended the due date for the homework, right? Remember? I made it next week instead of having that this week, right before the exam. I think I made it right after the weekend to give you more time. It's for chapters 5 to 9. No, I changed 5 to 9, right? Oh, really? Okay, I will make them all due with the 9, okay? So they will all be due after the weekend. I thought I made it for everything. I'm sorry, it's my bad. Please don't. Exactly, please don't. I appreciate the gesture, but please don't. Okay. So if I don't, please someone remind me tonight. Shoot me an email if I don't do it by tonight, okay? Now, this is where you are asked to calculate the depreciation rate, okay? They will ask you which method. Like I mentioned before, it's not always that they will ask you for the first year. It will be for the second year or third year. So in this case, and remember, you did not see anything. So in this case, this is how we solve the problem. We start. We have the purchase, freight, and the cost for the building foundation. So you need first to calculate the cost. The cost is equal to 60,000 plus 8,000 plus 2,800. That's 70,800. The estimated useful life is 5 years. Estimated salvage value is 12. So the depreciable cost will be equal to 70,800 minus the salvage value. That's 70,800 minus 12,000 is equal to 58,800. This is the amount that will be divided by life, the useful life. So it will be depreciation expense using the straight line method here. It's equal to 58,800 divided by 5. Any questions? Okay. The second question is using the double declining balance. And remember, when they ask you for the double declining balance method, they are asking, the double means it's twice the straight line, the rate of depreciation of the straight line. And remember, the double declining balance method, the rate of depreciation is applied to the book value. So here the company purchased equipment that costs $40,000, and they use the double declining balance method. It has 5-year life and 2,000 salvage value. What is the depreciation expense recognized by the end of 2012? Okay? So that's at the end of the 3rd year. Remember, when you have a question like that, the best way to guarantee that you got the question correctly is to actually basically to do that table. You don't need to do it in a neat way. You don't need to do it in like really well-formatted way. Just do it in a way that would be fast. However, when it would eliminate the possibility of making a mistake just by skipping a step or something. Okay, so that's good. So we have here, what we have here is, we have, remember, the book value. The book value at the beginning will be the cost. This is because the accumulated depreciation when the company purchases the equipment is 0. So for the first year, we have 2010, 2011, and 2012. This is what we want. We have the book value, depreciation rate, depreciation expense, accumulated depreciation, and the new book value. So the beginning book value and the ending book value. Let's do that. The book value at the beginning it was purchased in January. So the book value was 40,000 multiplied by, it has 5 years. Let's do the rate here. The rate is equal 2 times that of the straight line method. Straight line method has 100 over 5, 100% over 5. You're dividing 100% over 5 years. So that's 20%. As a result, this one will be 40%. It's twice that amount. Depreciation expense will be equal to 16,000. Accumulated depreciation is 16,000. New book value is 24,000. This is the new book value, 24,000. For 2011, you multiply it again by 40. Depreciation expense will be 9,600. Accumulated depreciation is 25,600. So the new book value is 24,000. Is 24,400. No, it's 14,000. Sorry. 1 second. 14,400. This is again the new one. 14,400 multiplied by 40. It will give us the answer to our question. If the company instead asks you to calculate the depreciation, the accumulated depreciation, you will add this one, and this one. Any questions? And I have to admit, this is one of the difficult questions when it comes to depreciation. If you try to skip directly to that year, you will make a mistake. Most likely you will make a mistake. Try to do it stepwise like this. Okay? Did we cover the revising? Let's do that first, and then we come back. That's fine. I know that you saw. Okay, so we talked about depreciation and income tax. According to income tax, to the basically when the companies report their financial report, basically when they prepare the financial statements, they can use any of the methods that we mentioned before. Straight line method, double declining balance method. They can use units of activity depending on their own judgment. However, when they report to the IRS for tax purposes, the company must use either the straight line method or the modified accelerated cost recovery system, which is not allowed under GAAP. So under GAAP, sometimes companies might use two different ways to calculate depreciation, one for taxes, one for financial statements. Revising the periodic depreciation. Did we cover that? Just to remember, did we cover that in class? This is where, and I know that I'm repeating that, just want you guys to understand it before the exam. Now, revising periodic depreciation. This is when the company decides at a certain point to extend the life of their assets. Okay? So let's say that they purchased a truck. Originally they thought, or they estimated the useful life to be 10 years, and then they decided to keep it for 15 years. Maybe the truck is still almost brand new. They want to keep it. Or it is in very good shape. It's productive. It has very little downtime, so they want to extend the life. Whatever happened before they made that decision to change the useful life will not be affected. The company will not make adjustments to the prior years or prior depreciation. They're not going to change that. Whatever is in the past remains in the past. Okay? So this is where you forget about what happened in the past. The easiest way to think of it is to treat it as if it were a totally new asset. So you need to calculate the new book value. It's as if you're calculating the new cost. It's the book value. It's not the cost because you're not purchasing it. So you calculate the new book value. You add to that all the new information. You apply the new information to it. So let's see how this is done. So Arcadia HS purchased equipment for $510,000, which was estimated to have a useful life of 10 years. And a salvage value of $10,000. So this is the old information. This is the old one. Old one, old one. Depreciation has been recorded for 7 years on straight line basis. In 2015, that's 8 years. 7 years have passed. It is determined that the total estimated life should be 15 years. So this is the new one. That's the new life. A salvage value of 5,000. Now this is not exactly the new one. Let's call it the changed one. This is modified or changed. 5. This is the new salvage value. That's weird new. Yeah, even I have to admit that. So let's see how we do the calculations. Okay? Again, there are no adjusting entries, no correcting entries for previous years because they were correct. You were depreciating that asset according to the useful life that was decided before that change has happened. So they were correct. You do not make an adjusting entries and any correcting entries. That's not what you do. You start calculating the new, basically for the new periods. Now, the first thing to do is to calculate the new net book value. Okay? The new net book value is what? It's always the same. Book value. The net book value is always cost minus, so the initial cost, minus accumulated depreciation. Do we have the initial cost? That's how much? 510. We need to calculate accumulated depreciation. First of all, the company is using the straight line method. So depreciation expense for the first, you need to calculate it, and then because we have 7 years that have passed, you multiply it by 7. That's accumulated depreciation. So the company purchased that one, say in, when was it? They bought it year 8, so I think it was like 2007. In this case, to make it easier, you calculate annual depreciation expense. How do we calculate it? We have the cost minus salvage value, so that's the initial, and this is initial annual depreciation. So you have the initial equipment cost was 510,000 minus the initial salvage value, which was 10,000. That's 500,000. It has a useful life of 10 years, initial useful life. So annual depreciation used to be 50,000 per year. 7 years have passed. You multiply that by 7 is 350. This is the amount that will be subtracted from the initial cost. Once you subtract it, you get to the new net book value. So this is basically the net book value at the end. This is the one that we will use as if it were the initial cost. So this is the amount that we will use here. Now this is the new book value, right? It's 160,000. This is the new salvage value. This is the new depreciable base. That's the new useful life remaining. And this is the new annual depreciation. You plug in the new ones. You treat it as if it were a new asset. So you have, for example, the new salvage value is 5,000. You subtract that from 160,000, it becomes 155,000. Now the new useful life is 8 years. It's not 15. The question here told you a total estimated useful life of 15. Sometimes they will tell you it was extended by 5 years. So you have to pay attention to the way they actually give you the information. If they tell you extended by 5 years, it's the same thing as if they told you that the total useful life is 15 years. That's the same information. You just need to make sure what they are telling you. And then you have the journal entry will be every year after the 8th year, after the change, the new depreciation expense will be 19,375. Any questions about this? Yes?
So let's say it's like extended 5 years. Instead of the 8 years, it would just be 5 years.
No, it'll still be 5 years. And it'll still be 8 years. Let me put it this way. So let's say that it was originally in 2007, 2008, 9, 10, 11, 12, 13, 14, 15. 1, 2, 3, 4, 5, 6, 7, 8, 9, and 16. How many years are these? 10. It was extended by 5 more years. So it's also 17, 18, 19, 20, and 21. Are you guys okay with this? How many years have passed? This is how much it was extended. The total is 15. Now how many years have already passed? 7. So 1, 2, 3, 4, 5, 6, 7. How many years do we still have? We have 1, 2, 3, and 5 that were extended. This is how you need to calculate, because if you make a mistake, you have the whole question wrong. Just pay attention to the way it's worded. Any questions about that? Okay. Now we get to expenditures during useful life. So any equipment or truck or any basically plant asset will need some kind of maintenance. If you have a truck, you will need to change the tires. You will need to change oil, brakes, etc. every now and then. If it had a small dent, you might need to repaint it or something like that, right? Those are ordinary repairs. Companies will actually, in this case, they will simply record them as an expense. They will record them as maintenance and repair expense. Sometimes they also call them revenue expenditures because they are directly related to revenue generation. Okay, so those are expenses. Now, in certain cases, the company might have additions and improvements. Additions and improvements are different. They are not when you change the tires. Let's say, for example, the company had a truck with a small trailer. To improve the productivity, they purchased a new big trailer. Okay? Their productivity will increase, it will improve. This is not an ordinary repair. That's an addition. It's an improvement to the existing asset. As a result, the company will capitalize the cost. When we say capitalize the cost, it means that it will be added to the cost of the equipment. So for the truck, basically the company will debit the plant asset itself. It will debit equipment. Say that, for example, the company had a regular trailer and they wanted a refrigerator trailer because it will allow them to transport different types of goods. That will change or improve the productivity. This cost is not an ordinary repair. It's an addition to the existing equipment. Okay? Let's take another example. The company had a Xerox machine, but that Xerox machine cannot sort all the printouts, okay? You know that usually when you print, there's this sorting machine. This is an addition. So that if the company decides later on to buy another part and add it to improve the productivity of that equipment, this will be capitalized. When you say capitalized, you mean it's added to the asset itself. So the asset will be debited. Okay? Now, companies, they use judgment when they decide on whether this is an ordinary repair or whether this is a capital, basically capital expenditure. Auditors, they actually look at that information when it is material or significant. Remember materiality? Materiality, it simply means that if the amount is significant enough to make or to affect a decision, then it is material or important enough. It's material, and as a result, auditors would actually audit this information to see if the company used the right judgment when they actually made the decision whether to use it, to expense it or to capitalize it. Okay? That depends on every company, on the size of the company, on a lot of things. Any questions about this? We get to plant disposal. Plant assets disposal. This is when the company is getting rid of a plant asset. There are different ways of doing that. The first one is to sell it. Simply, the company will sell it. Say that the truck, which has a useful life of 10 years, 7 years later, the company decides to sell it. Maybe it's starting to break down a lot and they don't want to waste time or waste money on maintenance, they just sell it. Then the other type is when, if let's say that the truck was in an accident, it was totally damaged, there is nothing that they can recover from, they might retire it. This is retirement. So you have sale, retirement. Retirement is when they get rid of it and they don't get any cash in return. They're not selling it, they're just getting rid of it. The third part is exchange. We will not, there is an appendix in the book if you are interested in learning that. We're not going to go into detail about this. Exchange is simply, I just wanted to explain that. This is, for example, when you trade in your car. You are exchanging an asset for another. It's like when you have an old car and you want to buy a new one, you might go and you trade in your car. The same thing actually happens with phones nowadays, right? You can go, you trade in your old phone, you get a new one, they deduct the value of the old one. So there's an exchange. In a way, it's similar to when you trade properties in Monopoly. How many of you play Monopoly? Okay, I do. So, now, this is the same thing. When you trade properties, you trade one property for another. You're trading a plant asset. So you see, you have been exchanging plant assets without knowing. But this is what you do. Sometimes it's not just the plant asset. Sometimes it's not just an asset for an asset. But it's not like basically a property for a property. Sometimes there's also an exchange in money. So I might ask you to for a certain property, I will offer you one property plus additional money so that I will get the property that I want. Okay, so my daughter, for example, would always go for broad. She wants a broad box, so she loves it. My kids, they love Monopoly. You have so many types of Monopoly, and I play that a lot, trust me. Including Minions Monopoly, Monopoly Hotels, and Monopoly Empire, a regular one, and there is a mega one which I hate. It's like really, really long. It takes like hours and hours to finish. I always cheat so that it will finish early. But that don't cheat in the exam. I'm not encouraging you to cheat. That's just Monopoly. It's a game, and I don't want to waste or to spend like 10 hours playing that game. Now, what did we talk about the rules of the classroom from the first day? What happens in class stays in class. Okay, now, so the retirement of the plant asset. What do we mean by retirement of plant asset? This is when the company does not expect to receive any cash. They are simply getting rid of it. Here, the company will look at the difference between. The company will look at the difference between the book. Basically, between the cost and accumulated depreciation. So the way the company would record retirement of a plant asset is by debiting. You debit the asset, you debit the accumulated depreciation, and you credit the asset. So what you're doing is, you're saying that this asset does not exist anymore. I got rid of it, along with its accumulated depreciation. If accumulated depreciation is equal to the cost, it will be zero. There will be no losses. If, however, the company got rid of the truck that cost $20,000 and had accumulated depreciation of $16,000, the company will have a loss. Okay? Why? Because in this case the company did not get a chance to expense the whole cost. So the difference will have to be reported as a loss. So Hobart Enterprises retires its computer printers, which cost $32,000. Accumulated depreciation is $32,000. What happens? What's the journal entry? You debit accumulated depreciation, you credit equipment. As simple as that. You are basically removing that asset and its accumulated depreciation from your financial or accounting system. Good? Okay. What if those printers are still good, functioning, and the company does not want to get rid of them? No one can force a company to retire a certain asset after the useful life. If you have a truck, you're depreciating it for 10 years. After 10 years, it's still good. You don't have to sell it. But if the company decides to keep it, they have the right to keep it. No one can force them to sell it. So how would the company, how does the company act in this case? Because the company has fully depreciated that asset, what's the book value now? It's zero, right? The book value is equal to cost minus accumulated depreciation. In this example here, cost minus accumulated depreciation is zero. So the company will keep reporting that asset. It will still keep reporting equipment, 32,000, less accumulated depreciation, 32,000. Whenever a user of financial statement, the person or the company or the creditor or the investor who's looking at the financial statements, when they see that the company has equipment for 32,000 and accumulated depreciation for 32,000, they understand that this equipment, the company decided to keep using it, although it was fully depreciated. So the company will keep reporting it every year with a book value of zero until they actually get rid of it. They will keep recording equipment, 32,000 less accumulated depreciation for 32,000. That's what happens. And when someone reads the financial statement and they see that the book value is 0, they understand that it was fully depreciated. However, it's not going to be, the company is still using it. Now, the company will definitely stop depreciating it. They have already allocated the cost. Accumulated depreciation cannot be over the cost, because accumulated depreciation is actually the allocation of the cost, right? This is how much costs have been allocated. So you cannot have cost more than the actual cost. Once it reaches this, like here, like in this case, once it reaches a book value of 0, you stop depreciating. There will be no depreciation expense for that asset. It will still be reported as equipment less accumulated depreciation. Yes?
How can you just stop changing the years?
Well, there's a difference. That's a good question, actually. So the thing is that when you change the useful life, you do that when you know in advance that you are going to keep the truck working. So you make the decision in advance. The difference is, one of them, you're making the decision in advance. I want to keep that truck for 5 more years. In another case, it will be like, okay, I use it for 10 years, and I look at the truck and it's still good enough to use for my operations. After I have fully depreciated. Remember, when you make a decision to extend the useful life, you do not adjust the previous years, right? So in this case, accumulated depreciation was, if you want to think about it, it's the same thing. But here the new book value is 0. So if you remember here, so let's see here, in this case, if it were 0, and 0, so this one is 0, so this one it was 0. You divide 0 over how many years? Depreciation expense will be what? 0. It doesn't matter anymore. So this is why it's the same thing. However, one of them, the main idea is that one of them you made the decision in advance. The second one, you actually decided after you have depreciated the whole asset. Any questions? So, Sunset Company discards delivery equipment that costs $18,000 and has accumulated depreciation of $14,000. What's the journal entry here? You will always debit accumulated depreciation and credit what? Equipment. That's correct. The difference between the two, if there is a difference, it will be recorded as loss. Now, in this case, we have accumulated depreciation will be debited, 14,000, and we have a loss. Now, loss is what? Loss is like an expense. Remember, losses are reported under other expenses and losses. So loss on disposal of plant assets is reported on the income statement under other expenses and losses. And when expenses increase, what do? You debit them, because they have a normal debit balance. So the loss would have a normal debit balance. Your losses increase by 4,000, so we debit loss on disposal of plant assets, we credit equipment the cost. Equipment will be credited at cost, because you are actually basically getting rid of it. Any questions? Okay. Now, it's different. In this case, sale of plant asset. The company decides to sell the truck. You have to calculate accumulated depreciation. You have to calculate the book value. So the loss or gain is simply the difference between the proceeds and between the proceeds and the book value. Proceeds from sale is whatever the company receives from the sale. They sell a truck, they receive $10,000. That's the proceeds from sale. This is what you mean by proceeds revenue, the proceeds received. So this is the proceeds from sale. The difference between that one and the book value will either be a gain or a loss. If the company sells the truck for a higher amount than the book value, So if the proceeds exceed the book value, the company will have made a gain. If the proceeds were less than the book value, the company had a loss. Let's see how this is recorded. So on July 1st, 2015, Wright Company sells office furniture for $16,000 in cash. Office furniture originally cost $60,000. So this is the original cost. As of January 1st, accumulated depreciation had a balance of $41,000. Depreciation expense for the first 6 months is $8,000. Remember, the book value, it's not at the beginning of the year, it's the book value on the day of the sale. So if you, for example, you're selling the truck end of April, you have to depreciate from January to April. Do you understand that? So in this example here, the company made the sale on July 1st. Accumulated depreciation until January 2015 was $41,000. You need to add to that the amount of depreciation during this year until the asset was sold. First thing you need to do is to calculate accumulated depreciation. So remember, first you calculate, you have to record. So they are asking us to write the journal entry. What happened on that day? You have to first recognize depreciation expense, which will give you the new balance and accumulated depreciation. So here, how do you recognize or how do you record depreciation? You debit depreciation expense, you credit accumulated depreciation. They told us it's 8,000, so we debit depreciation expense. And 8,000, we credit accumulated depreciation 8,000. This 8,000, this is from January through July 1st. Basically, it's from January through June. 6 months. On January, the balance of accumulated depreciation was 41,000. Here is plus 8,000. Think about it like this. Again, accumulated depreciation. It had originally a balance of 41,000. During this year, you recorded 8,000. So you credited accumulated depreciation 8,000. What's the new balance? 49,000. That's our accumulated depreciation. This is the amount that will be subtracted from the cost. So the book value in this case is equal to 60,000 minus accumulated depreciation. The ending balance on the day of the sale, it was 49,000. So the book value is 11,000. Because the book value is 11,000 and the company sold that equipment for 16,000, they sold it for more than its value according to their books. So according to their books, they made a gain of 5,000. Gains are what? They are some kind of revenue. So when they increase, we credit them. We know that we are going to debit accumulated depreciation and credit equipment. How much do you debit accumulated depreciation? 49,000. Right? You also need to debit cash. This is the 16,000 that the company received. That's the proceeds from sale. We also debit accumulated depreciation, 49,000. Equipment will be credited 60,000. This is at cost. The difference between the two is a credit to gain on disposal of plant assets. Any questions? Now let's say that instead of selling that furniture for 16,000, the company sold it for 9,000. We have the same numbers. However, here we have the proceeds are less than the book value. It's basically what you're saying in plain English. The company sold something that they believe for an amount that they believe is less than its value. So there is a loss. In this case, it's a loss of 2,000. Cash will be debited 9,000. Accumulated depreciation will be debited 49,000. Okay, there's a loss of 2,000. Will be debited. Equipment will be credited 60,000. Any questions? If you guys looked at the sample exam, I think there is an exam, one question in the sample exam that says that is similar to this. You have to calculate the gain or loss on the disposal of plant assets. First, you need to calculate accumulated depreciation until the day of the sale. Then, you subtract that from cost to get to the book value. You compare the book value to the proceeds from sale. If the book value is higher than, if the proceeds are more than the book value, the company may gain. If the proceeds are less than the book value, you record a loss. Any questions? Okay, let's do this one here. Okay, so here we do have majority of guys tried. Let's see how this is solved. Equipment was purchased for 800,000. That's cost. It has an estimated useful life of 8 years and residual value. Residual value means what? Salvage value. So residual value is the same as the salvage value of 120. Depreciation is being computed using the straight line method. What amount should be shown for the equipment net of accumulated depreciation? What does it mean? What's equipment net of accumulated depreciation? The book value. So this is the same as saying equipment less accumulated depreciation, which is the book value. So what's the book value? How do you calculate the book value in this case? Book value is equal to cost minus accumulated depreciation. Do we have cost? Cost is 800,000. So what we need to calculate is accumulated depreciation. How do you calculate accumulated depreciation? This is using the straight line method. Okay? We start by depreciable cost is equal to the cost minus salvage value. This is 680,000. We divide this one by the useful life of 8 years. And that will give us depreciation, annual depreciation. Sorry. Expense of 680,000 divided by 8. How much is that? 85,000 is equal to 85,000. Now, this was purchased in 2010. The company wants to know in 2011. So that's how many years? 2 years, right? 2010, 2011. So we multiply that. So accumulated depreciation will be 2 multiplied by 85,000. That's 170,000. Okay? This is basically, you're saying here 85,000 for 2010 plus 85 for 2011. This is the amount that will be subtracted here. So now we have the book value is equal to 800,000 minus 170,000. It's equal to 630. Any questions? Is this problem clear? Okay. So if they told you, for example, that, let's say that they gave you one additional piece of information and told you that they sold the truck, and the truck equipment. They sold that equipment on basically January 1st, 2012. They sold it for, say, 700,000. Would you have a loss or a gain? A gain, how much? 70,000. You would subtract the book value from the proceeds. If the proceeds were 700,000, you subtract that from 630. So we are done with equipment and buildings and plant assets. Now we'll talk about natural resources. Natural resources are like coal mines, oil, forests, etc. They are different. They are, in a way, they are physically extracted. Plus, there's one distinctive characteristic is that they are not replaceable except by act of nature. It's not like something where, for example, your coal mine is basically is depleted, where you can go and buy or replace it or replenish it. You will have to go and find another mine. Okay? This is why those assets are where we calculate depletion expense. We have accumulated depletion expense. So depletion to natural resources is the same as depreciation for plant assets. Companies, when they do natural resources, they always use units of activity because it makes more sense. Doesn't matter how many years you have a certain coal mine, right? It doesn't matter. It matters how much you extract from earth. Now, one thing, the cost again is within the same idea. It's the cost is any expenditures that are included in making it ready for its use. So, like for example, digging a well, that would be actually part of the cost. If you buy a land where you have oil and then the cost of building a rig on it or something like that, this is actually included in the cost. So let's see how we do the calculation. Again, the companies will use the units of activity. So for example, in this case, the companies will look how many units they extracted and sold. Not just extracted. Okay, so in this case, if they have extracted a certain amount that they have not sold, that would be recorded as inventory. Remember, we are trying here to match expenses with revenues. If the company extracted certain, let's say, several tons of coal, but they did not sell it, so they did not earn the revenue, right? Because they did not earn that revenue, they are not going to recognize the expense. Think about it as cost of goods sold. In this case, it's the cost of extracting, or that basically of extracting that. So it's basically the depletion expense will be based on the units that were extracted and sold. So in this case, here for example, once again, you have the total cost minus the salvage value. So this is similar to depreciable cost. Cost minus salvage value, and you divide that by the total number of units that you expect or you estimate to be extracted. In total, you will not be asked to estimate that number. This is basically, you have experts who do that. So in this case, you will be told that the estimated total units will be like, I don't know, 1 million units, something like that. You divide it. So you divide this total cost minus salvage value, you divide it by the total number of units, that will give you depletion cost per unit. Remember, we had the depreciation cost per unit, now it's the depletion cost per unit. Multiply that by the number of units in a certain year, by the number of units that were extracted and sold, it will give you depletion expense for that year. Okay? So this is extracted and sold. Let's look at an example here. Lane Coal Company, invest $5 million, that's the cost. In a million, estimated, 5 million in a mine, estimated to have 10 million tons of coal and no salvage value. So this is the cost, no salvage value, has 10 million tons. In the first year, the company extracts and sells 800,000 tons. First, you always calculate, this is whenever you're using units of activity, you have to calculate the cost per unit, whether depreciation cost or depletion cost, and then you multiply it by the number of units during that year. So in this case, we have the cost is 5 million minus 0 salvage value, divided by the total estimated number. So this is actually 5 million. 5 million minus 0 as salvage value. You divide it by the total number of units, it will give you 50 cents depletion cost per ton. During that year, the company made, extracted and sold 800,000. You multiply it by the 800,000. That will be 400,000. The journal entry in this case will be what? Depletion expense, accumulated depletion. Very similar. The depletion to natural resources is the same as depreciation for plant assets. Okay? Any questions? On the financial statement, the company will have depletion expense. Basically, it will have, not depletion expense. On the balance sheet, the company will have the asset less accumulated depletion. This is the book value of that asset. Any questions? Remember, any units that were extracted but not sold will be recorded to inventory. They will be added to inventory. Later on, when the company actually sells them, they will recognize, at that time, they will recognize the revenue and the expense. They will multiply that number by depletion cost per unit. That will give them depletion expense for that period. Any questions? Okay, let's calculate this one. Okay. I will give you a smiley face. Now, let's see how we calculate this one. Again, you need to calculate the depletion cost per unit. So the company invested 60 million with estimated 20 million ton no salvage value. It's expected to be in operation for 5 years. That's irrelevant. We don't care about this. How do we calculate this one? You need to calculate the depletion cost per unit, which is equal to cost minus salvage value divided by the total estimated units. That's 80 cents per unit, per ton. Okay? In this case, multiply 80 cents by the number of tons that were extracted and sold. That will be equal to 800,000. Any questions? Okay. Now we'll talk a little bit about intangible assets. So intangible assets are, we talked about this before, those are the assets that do not have any physical substance, like intellectual property, copyrights, franchises, patents, all these. They are assets because those are resources that can generate revenues. Okay, they have the ability to generate revenues. Okay? Now, some of them they have unlimited life, indefinite life. Others they have a limited life. For example, when you talk about when it has an asset like a patent, it has a legal life of 20 years. Then, unless a company makes changes to it, it will expire. After that, it becomes available to everyone. So the cost is cost of basically acquiring that patent will be amortized. So here in the same way, it's like depreciation, we have amortization expense. The cost of intangible assets, of those intangible assets that have a definite life. Those who have a definite life will be amortized. Okay? However, the company does not use here a contra asset account. The company is not going to actually use something like accumulated amortization. They will straightforward credit the asset itself. So they debit amortization expense and they credit the asset. If it's patent, they will credit patent. Okay? Indefinite life, intangible assets, they will not be amortized. Again, if you remember, land, because it has an indefinite life, we do not depreciate land. So this is in the same way. Okay? So here the cost is the purchase price, and sometimes, and in certain cases, it's the legal fees that are paid to defend it. Because those are costs included in acquiring that asset. So for example, patents. The war over patents between Samsung and Apple, right? It was always about infringement of copyrighted stuff, etc. That was basically patents. Apple has some patents, Samsung has some patents. And they are trying to use something similar, they started suing each other. And a patent, the legal fees that are paid to defend a certain patent. So for example, if Apple or Samsung they hire lawyers to defend their patents, the legal fees will be included in the cost. They are capitalized. Actually, sometimes there is like an expression where it says a patent is as valuable as, basically, as the amount that you are willing to pay in order to defend it. Because beyond that, you don't care about it. Now, legally speaking, it has 20 years of useful life. On the other hand, in reality, most of the patents, they become obsolete with time. So for example, a laptop, the technology that was used 20 years ago, it's now more or less, it's much, much less valuable than it used to be, right? So this is why you will be told, for example, that it has a useful life of 8 years or 10 years, something like that. The legal lifetime is 20 years, okay? R&D, research and development, those are expenditures, those are expenses, because it is very difficult to actually link a certain research and development expense to a specific product. So for example, when Apple designs a new chip for their mobile devices, it's the same chip that could be used, for example, for an iPhone 6 and 6 Plus, or for an iPad mini. So it's very difficult to link it to a specific product. Sometimes it's also difficult to link it to a specific period of time, because the iPhone will be sold next year as well, and that will also keep generating revenue. So how are you going to do it? This is why, although research and development are very high sometimes, they are still considered as expenses. Okay? So for example, National Labs purchases a patent at a cost of $60,000 on June 30th. National estimates the useful life of the patent to be 8 years. Those actually are always, so companies that use the straight line method to amortize intangible assets. It's very simple. They tell you that the cost is $60,000, the useful life is 8 years. You divide 60 by 8 years. The annual amortization expense is $7,500. As simple as that. The journal entry to be recorded on December 31st, that's for 6 months. It's for half a year. So this is the annual expense is 7,500. As a result, the 6 months, for the 6 months period, at the end of the year, the company will record amortization expense will be 3,750, and then patent will be credited. There is no accumulated amortization. Patent will be credited 3,750. So, copyrights are the rights for a certain published work, whether it was music or like a book, something like that. The useful life, the legal useful life, is the life of the author of that work plus 70 years. However, in reality, most of the time, the useful life is much, much less than that. Okay? How many of you have ever read a book that was over 70 years old? That's very few. How many books have you read that are over 70 years old? Except, I'm not talking about, like, don't start giving me Shakespeare and like Dickens. I'm not talking about those. I'm talking about like a novel that is 60 years old or 70 years old. So that's a different thing. Don't go down that road. But generally speaking, you're talking about the books that you are buying are not, they don't have the same thing. Those become in the public domain. Okay? So, like for example, there are certain books by Agatha Christie, and I like Agatha Christie. How many of you have ever read a book by Agatha Christie? Okay, I like her books. I've read her books and all the collection in different languages, to be honest with you. Now, so in this case, the same book, I know that sometimes it's ridiculous, but I read the same book and I know who the murderer is, I still read it, and I keep reading it. And I read one of them in 4 different languages. I like it, I love those books. However, it's not always that you read those books that are over 70 years old. So the useful life of copyrighted material, most of the time, is much less than that. Okay? Here, the company would amortize the expense over the useful life. Doesn't have to be the legal life. It's actually what they expect it to be useful for. Trademarks and trade names, that's for example, the M from McDonald's, the shape of the Coca-Cola bottle, and those they have indefinite life. Because originally speaking, they are 20-year periods. However, they are automatically renewed as long as the company is using them. So for example, as long as McDonald's is using the M, it will remain their trademark. Okay? So in this case, because it has an indefinite life, this asset will not be amortized. Okay? You simply capitalize the cost of acquiring that asset, but you do not amortize it. Any questions? Okay. Franchises. This is, for example, if you are going to buy a franchise from Subway or Dunkin' Donuts, etc., you have to pay the right to sell their products and basically to use their name and to sell their product. Usually, the franchise, it could have either an indefinite life or sometimes it has a definite life. Okay? If it has a definite life, it would be, so that depends on the agreement. Okay? Annual payments to the company, they will go as expenses. So those are operating expenses. Do not get mixed up. You will not be asked to write journal entries for intangible assets in this course. It's beyond the scope of this course. But you just need to know to understand the concept. Okay, so you just need to understand what you mean or how in general you treat, for example, copyrights. Okay, and whether copyrights have an indefinite life or what the indefinite life, what the legal life, etc. Goodwill is only known and is only calculated once the company sells, once the whole business is sold to another company. It's the only time that you can actually calculate goodwill. And goodwill is the difference between the net assets and the sale and the amount that it was sold for. So for example, when Facebook purchased WhatsApp, I think I'm just giving a number, I can't really remember the numbers, but I remember that the net assets of WhatsApp were less than $1 billion. Say that it was $1 billion. Facebook paid for WhatsApp 14 or 15 billion dollars. The difference will be recorded as goodwill. And this is what happens when the company, the purchasing company, believes that the value of that company is more than the reported assets. Basically, why did Facebook pay for WhatsApp that much? Plus, for their users database. They wanted to have their users database. That was it. This is what they paid for. They didn't have buildings and stuff like that that were valued for $14 billion. Instead, they had a very important user base. This is what they wanted. And this one is not amortized. Research and development, those are expenditures. Those are expenses, and usually they are recorded as incurred. Or again, for the same reasons, that those might lead to assets, sometimes they don't. However, there is one issue with it, is that it's very difficult to link it to a specific period of time or to a specific product. So in this case, what are the term bases that are associated here? The allocation of the cost of a natural resource, depletion, rights, privileges, and competitive, etc. for advantages that result from the ownership of long-lived assets, intangible assets, exclusive rights granted by federal government to reproduce and sell an artistic or published work, copyrights, and we have here franchise and research and development. This is how the portion. This is the balance sheet, how it looks like. You have PBNE. Sometimes companies report accumulated depreciation by category or by class or in total. Okay, so you have buildings, land, equipment, and then you will have either accumulated depreciation per class or in total. And then you have, for example, intangible assets. Any questions? Now, again, this is to calculate this is to analyze asset turnover. You divide the net sales by the average total assets. Basically, what you're trying to say here is how much every dollar invested in assets, how much sales would it lead to? So in this example here, when every dollar invested in assets will lead to 62 cents in sales. The higher the number, the more efficiently the company is using their assets. Okay, so this one, it tells you about the efficiency and the productivity of the company. This is basically the productivity of the company's assets. How much they are producing. Any questions? Okay. If you have any questions, I just wanted to remind you of a couple of things for the exam. The exam is on Friday.